we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
The opening about 1 hour and about 12 minutes away. Going into that cash open, we are just about positive by almost 0.1% on the S&P 500. Bond yields a little bit higher once again. A trend emerging over the past 6 days. 6 consecutive days of 10-year yields climbing higher. It's a grind, but it's happening in one direction, up by 4 basis points. Lisa, 378.87.
Yeah, every single day since the Fed cut rates, the implication here on the margins is that you would see potentially stickier inflation because the Fed is looking to be more accommodative now. We'll see whether that changes, but right now that's the tone.
I'm told by someone in the know there are some bond auctions. $69 billion of 2-year notes today, 5-year notes tomorrow, the day after that, $44 billion of 7-year notes. What is it about that 7-year maturity that spooks this market a little bit now and then?
It's not as liquid. So when you have a greater volume of bonds in the market of a certain denomination, it tends to have more receptivity because there's a bucket, there's a tranche in people's portfolios that are devoted to that. 7-year, it's sort of out there. The 20-year is really like that. It's just not very liquid.
Yeah, I think even Mnuchin himself, who brought the 20-year back, said that maybe we should sort of retire the 20-year.
Yeah, I think we should make the 20-year great again.
You want to try and do that?
I'm going to try to do that.
Okay, good luck to you. The
Thanks.
7-year auction about 2 days away. Time now for some morning calls. First up, Jefferies cutting Starbucks to underperform and setting a new street low price target. The analysts saying the company's many issues will take time to fix. Their stock is down by 0.5%. Next up, Oppenheimer raising lows to outperform. The analysts saying moderating interest rates tend to underpin stronger demand for home-related products. Their stock is up by 1.3%. And finally, Piper Sandler upgrading Salesforce to overweight, citing favorable risk-reward given the potential for the software company's free cash flow per share to double by 2029. Their stock is up by 1.9%. Turning to Tesla, Barclays looking for third-quarter delivery estimates to come in higher than expected. The outlook sending the stock to its highest level since July 23rd. The analyst saying this could keep sentiment positive, heading into Robo-Taxi Day on October 10th. Bloomberg's David Welch joins us now for more. David, let's start with deliveries, and then we can get to the Robo-Taxi Day. What is it that's coming from Barclays that gives them the optimism that deliveries might pick up?
We did see insurance registrations in China that showed, while still down from the week before, Tesla had actually healthier than expected sales in China. And look, the narrative has been that BYD and the other big Chinese car companies are eating everyone's lunch, and really they are. But Tesla's showing some resilience there. I think that's going to help. We're also generally seeing in the U.S. an uptick in EV sales in the quarter. That's the kind of preliminary data I've seen. A lot of it is because of discounting, and we haven't seen big price cuts from Tesla, but when all the other EV makers start discounting and there's more specials out there, it gets consumers shopping, then maybe they look at Tesla, so you get a little bit of a knock-on effect. So, maybe stronger than expected in China, a little bit of a bounce in EV growth back in the U.S., and Tesla could have a pretty decent quarter. I think that's what Barclays is weighing on.
And one region left, David, to cover, Europe. The EV numbers out of Europe just haven't been great recently, not the numbers that I've seen anyway. For Tesla specifically, any indication that they're doing okay in that region?
Tough to say. Europe has been pretty sluggish for EV sales for a little while now. I would think that if Tesla's going to show a surprise, it'll be on the strength of what we might see in China and here in the U.S.
Why is it Robo-Taxi Day? It's like Prime Day or one of these other days. What is Robo-Taxi Day, David?
Tesla was supposed to do this back in August, and they delayed it. This is when Elon is supposed to show us his plans for his fully self-driving vehicle. And it said, look, they used to call their partially self-driving vehicle full self-driving and autopilot. They've had all these names. This one's supposed to be a true robotaxi, be able to drive itself. The idea is people who own the car can actually have other people getting rides in a whole fleet of autonomous vehicles driving around. And everybody is really on the edge of their seat to see what Tesla has, because unlike with Waymo, which is Google, unlike Cruise, which is General Motors and the other companies who've been testing vehicles in markets, offering rides even for fares at certain points, we haven't really seen Tesla fully autonomous vehicles out driving around in any cities anywhere. They've been kind of testing them privately, and we just don't know what they have, because there are other technologies that we've seen actually sold were partial self-driving or what we call driver assist. So that's the big question. Can Tesla show us a completely autonomous vehicle? And then once we see that or hear what they have to say about it, what's the business case around that? Because that's something else we haven't really seen materialize yet, is how does everybody make money on this thing? These cars are very expensive. They're tough to service. How's Tesla going to do this? And is it a huge growth engine for the company going forward?
Well, there's also a question. Let's say they can build it. Will it be allowed to be sold? And also, especially at a time where supply chain issues are a big concern, how much has this become a security issue?
Well, Tesla's developing their own hardware, their own internal software. I doubt they've got any Chinese or Russian software or software embedded hardware in the car. They'll be able to do that. The question really is, how effective is it? What does the vehicle actually do? And can they get a lot of them out there on the road? And what's it going to cost? There's a lot of questions here, but Elon Musk is very good at keeping a narrative going, keeping hope going that there's growth in the stock. Because, look, Barclays is seeing some EV growth, but you know, the EV business is sort of stabilizing for Tesla. There's still room for them to grow and certainly for others to grow, especially in the United States. But, you know, as you and I have been talking about for many months now, the EV business is just not meteoric growth like it was for Tesla. So to justify that valuation, Elon's got to have a narrative that there's a new business and this is what it is. And everyone's wondering what he really has.
David, what's the permitting like right now? Because it's a state-by-state basis whether or not self-driving cars are actually even legal.
Yes, it's a patchwork quilt of very permissive states like Arizona and Texas, where Cruise and Waymo are doing business. And then you have pretty restrictive states, California, New York, very tough to run AVs there. The federal government is kind of willing to let this happen if you still got actual steering wheel, braking pedals, gas pedals, all that, I should say electric pedals, to operate the car. They have to work. You can have this other software on there. You can run self-driving vehicles, but if you start to have problems, they would probably very quickly ground them. You know, you can run these things in some of the states. Tesla being in Texas now, they'll be able to run them there until there's a problem. And we saw that, right? Cruise was in Austin, and they had problems in California, other problems in Austin, and they had to shut down. And Cruise has not gone back to Austin. They're in Dallas and Houston right now with their sort of initial testing that they're doing. So he could do that in some of these, some of the Smile states, Sunbelt states, where there's pretty permissive AV regulations, but it's going to have to be very flawless in its execution to stay on the road.
David, appreciate the update. David Welsh there on the latest with Tesla. That stock is up at a pre-market by 1.6% after closing at 2-month highs in yesterday's session. Up next on the program, we'll catch up with former Fed Governor Betsy Duke. We'll speak to Rob Waldner of Invesco. Your equity market just about positive throughout the morning so far on the S&P 500. Yields are shifting higher on a 10-year close to 380, up by 5 basis points on the session. From New York, this is Bloomberg.
wife drives FSD. There's a term called the wife test. My wife will only drive our kids on FSD. It's incredible.
That is a great. I mean, the sort of significant other test is a very a good test because for a while there was like, you know, friends or significant others would be like, please don't put it on. It's too scary. But then it's getting to the point where, I mean, it's going to be just smooth as silk. So in fact, you'll be able to visually tell, perhaps even now you can, visually tell if the car is being driven on FSD or manually, because if it's being driven on FSD, it's smooth and precise. And if you look at if you actually closely observe cars going down the highway, the people are constantly moving in their lanes. So the cars are like doing this all the time when they're manually driven. If it's actually on FSD, it's dead center in the lane. It will actually get to the point where it is not merely, and maybe is at that point, not merely safer than a person, but actually way smoother than manual driving. I can't say enough about the profundity of full self-driving. It is just one of the biggest changes in history that will occur. It's not some feature. it's like a profound. It's really as profound as electrification. And we already have millions of the cars on the road that will literally achieve this with a software update. I mean, that's like head exploding emoji, you know? I think probably a lot of people in this room realize it, but most of the rest of the world doesn't. Yeah, so.
Given how incredible FSD is and how much, you know, merit you're giving to potential future margins of the car, as well as how much impact on society, and given that they didn't even want you to say if it's going to happen this year, just, you know, not to jinx it,
sure.
Would it be possible to have just for some type of public-facing, investor-facing kind of timeline, so that way, you know, you mentioned V12 is coming, and that's, you know, AI front end. Could we just see kind of a timeline on this is the version we're at? These are the things we're working on, and this is when we're, you know, ETA. So we can kind of see that in real time instead of maybe Elon time.
So the thing that's been, really difficult with full self-driving is that it very often seems like it's about to happen until you realize that you're actually at a local maximum and that you need to re-architect elements of the software to get out of the local maximum to then a higher local maximum. So it's been this sort of series of logarithmic curves. And that's why it's been like, it seemed like, oh, if you just extrapolate this on a straight line, it gets to self-driving, except that it's not a straight line, it's a logarithmic curve, and it sort of, and you start hitting these like local maximums where you'll sort of asymptote to a certain capability and then have to re-architect things. So now I think we're finally at a high enough local maximum, or will be this year, where to the point where it is, I think, probably safer than a person, meaning the probability of injury on average will be better than a person, even if someone pays no attention to the car. It is worth saying that right now, for human supervised Tesla full self-driving, it is dramatically safer than manual driving. It's like, I think like 4 times safer, maybe more. So it is already a massive safety improvement to have human supervised FSD right now. And I think we will get to the point where we're always going to be in some amount of local maximum, but I think that we'll be in a local maximum that exceeds human level safety this year. Yeah, but I guess we'll see. So anyway, I want to thank you all for coming, and so.
Said They supported last week's 50 basis point cut. Joining us now is the former Fed Governor, Betsy Duke. Betsy, we've got a lot to talk about. Welcome back to the program. First of all, we'd just love your first reaction to the decision from last week. Were you surprised, and what did you make of it?
So I was surprised. I was expecting 25, but it looked to me when I looked at the SEP like they were about evenly divided between 25 and 50. And I think the arguments for the 50 with the communication that Chairman Powell was able to manage, I think made 50 a perfectly reasonable cut.
Goolsby's come out swinging at the Chicago Fed. He's made a lot of noise and said that maybe we're hundreds of basis points above neutral. If the Fed is offside relative to where neutral is, what's your best case of what neutral is at the moment, Betsy?
So I think neutral is definitely north of 3%. In fact, I think there may be a range of neutral between 3 and 4. And, you know, one of the things of having been in banking for so long is that for most of my banking career, neutral was closer to 4.5. And it was only in the since the financial crisis that the estimate of neutral got as low as it did. So I think the super low rates that we've seen will not become a form of neutral.
Betsy, can you elaborate on that in particular, what current Fed officials certainly believe neutral to be now, which is below 3%. You believe it to be north of 3%. How much do you think that could be a potential liability for Fed policy going forward?
Well, I think it's the biggest conversation they're going to have over next year. This year is pretty well set. You can expect 2 quarter-point drops this year. And next year, if they get closer to the inflation rate that they're looking for, and unemployment stays about where it is, then that would tell you to go to neutral. Question is, where is neutral? And there's not a reason to slam up against neutral. If you look at what's happened, even with the increase in rates that they've done this cycle, it didn't seem to have that much effect on unemployment because this was a supply-side driven cycle. And that's what makes this one really tough to predict for the models.
This is an important point, and you prefaced it by saying you'd been in the banking business for a long time and you'd lived through north of 4% neutral rates. How much do you think this is what the longer end of the yield curve is sniffing out right now, that maybe the Fed on the margins is going to err on the dovish side and allow inflation to be a bit more entrenched than it otherwise would be?
So I can't begin to guess what's really going on in investors' minds in the long-term Treasury market. You know, I don't know how much of it is based on what the debt is, which is going to tend to keep rates higher. I don't know how much of it is expectations of where neutral's going to be. I just don't know.
Betsy, when it comes to, you know, the Fed, you saying that you'd be surprised if they take rates below 3%, is that also because you have this question mark about the fiscal trajectory of the United States starting in 2025?
Well, the fiscal trajectory is going to be tricky. First of all, you have the Trump tax cuts, which will expire at the end of 2025. So there is going to be a change in tax policy and fiscal policy, even if the Congress does nothing. So you have that coming up, that to look at. And the debt that the U.S. has is just plain unsustainable.
But what about when it comes to, instead of fiscal policy, when it comes to potential policy coming out of the White House? I'm thinking of this potential, this idea of tariffs, much higher tariffs, 10% ring, 60% potentially when it comes to Chinese imports, if it's a former President Trump getting back into the White House. How concerned do you think the Fed is about inflation in 2025?
I think the Fed's going to pay attention to inflation, but probably what they're looking at more than any campaign promises is really what's happening with real estate, because that's the sort of the last piece of taming inflation. And the problem in real estate is that you've had not enough housing for over a decade. When I was at the Fed in 2012, we estimated that it would take 5 years of 2 million starts to make up the shortfall at that point, and we haven't had anything close to that in the last 10, 12 years.
Betsy, every single person who's come on the show just keeps repeating a lot of what determines next will be the labor market at a time when the labor market data has been pretty messy. We heard from Fed Chair Jay Powell that he's really watching the revisions to understand how to understand some of the data that we've already gotten. When you were on the Fed, did you understand the data to be this messy, or is this unique?
So if you just look at the number of jobs created, that is the worst indicator, I think, ever. I'm a little bit bitter about it because, as everybody knows now, I was very concerned about QE3 and very reluctant to get on board with QE3. And we had a jobs print that just pretty much demanded it. But when we got to the point where all the revisions had come in, the job number that we ended up with for that month would not at all have supported the arguments for QE3. And then when you look at the models that are built, the economic models that are built, they're generally built with revised data. So you have to be careful about a number that can be revised up or down 100,000 or more. So I don't pay attention as much to that number. The second thing about that number is that you have to, and I think Chairman Powell alluded to this in his press conference, you have to pay attention to how many workers are coming into the workforce. The U.S. workforce is growing by something like 65,000 a month. So anything above 100,000 is really a lot of jobs for not so many workers. The supply side, again, has come into play here recently because we've had much more immigration. But again, politically, not sure where immigration is going to go. And you have to have enough workers to keep the economy growing at 2%.
In this framework, it seems like the Federal Reserve is putting an emphasis right now on the labor market. Do you think that they should put a little bit more emphasis on inflation?
I don't read it that they're putting all that emphasis on the labor market because the labor market's not far from where they'd like it to be. I think it's more that it's balanced now. It's not the focus entirely on inflation, but it's really a more balanced view.
Betsy Duke, former Fed Governor. Betsy, always appreciate your perspective. Thank you. The perspective on the Federal Reserve seems to be some daylight there between the Fed's view and the way the market views things. I think market participants overwhelmingly believe this market is now, this Federal Reserve rather, is a single mandate Fed, very focused on the labor market after declaring victory over their inflation objectives.
Which is a reason why person after person says that the jobs number is really going to dictate whether they believe in the soft landing or not. Of course, that jobs number could be muddied 6 months later with a whole host of revisions. But this really is, I think, daylight between members themselves.
True.
Because some of them think that and some of them don't.
50 minutes away from the opening bell, equity futures just about positive. I want to check in on the bond market and the long end of the curve. For 6 consecutive sessions, yields have been climbing. That is the longest such streak going back to March of this year. On a 10-year, we're up almost 20 basis points over that period, something like 18 at the moment. We've reclaimed 380. On a 10-year, we're up 5 basis points on the session. Rob Waldner of Invesco joins us now for more. Rob, your line at 375, which was only 5 basis points ago, you are tactically short the 10-year. Why this short position on the 10-year, Rob?
Well, I think, Jonathan, you have to look at what the market is pricing to for the Fed. And, you know, the market is now, there's 2 potential risks for the 10-year note. One, the Fed is really easing policy quite quickly here, or much quicker than the market expected. And as a result, you would expect to see this yield curve steepening as easier policy brings the short end of the curve down, but doesn't do anything about, containing the long end. So that's part of the factor here is we're getting this twist, this yield curve steepening. But I think the other thing that we need to take into consideration here is the market has also kind of totally bought into the story now that inflation is dead. The labor market is quite weak, and the Fed can get to 3.5 is on a route to 3.5, right, to get back to neutral. There's certainly risks to that narrative, and we've seen the market narrative get proven wrong over and over and over again over the last couple of years. And one risk to that narrative, or I think most of the risks to that narrative, are to the upside. We get another bad CPI piece of data, or we get some very strong labor market data, or something in that vein, which should move the overall level of rates back up. Because this narrative now is fully bought in, uniquely fully bought into the Fed's view.
Hold on a second, Rob. I agree with you about inflation. About just the labor market in general, though, there seems to be a discrepancy between some people who say that the bond market's pricing entirely just looks at the inflation levels and the fact that the Fed is just normalizing, calibrating policy rates to be close to that. If you look at equity markets, they're embracing a soft landing. They're embracing that things aren't that weak and that the Fed is going to make sure that they aren't. So are you saying that both are being baked into bonds, that essentially where yields are now implies some sort of recession?
No, I'm saying that I'm also saying that the bond market is baked in this kind of soft landing, right, where the pressure is coming out of the economy, rates can kind of slowly move down, and the overall level of rates has come down. I think one of the key things that has driven the bond market uniquely over the last 18 months has been the Fed view. So the biggest driver of the overall level of yields as we've come down here has been the remarking of the Fed's expectations. So I think it could also happen in the reverse, which is we unmark the Fed's expectations, you would get the overall level of rates going back up. You might not get you wouldn't get a steepener at that point. You might get a bit of a flattener, but you would get the overall level of rates going back up.
How short are you? What are you sort of expecting in terms of
it's a tactical short? You know, I think I want to send the message that as bond guys, our value proposition is great, and it's as good as it's been in a very long time. And that the yields that you can get overall in the bond market are quite attractive in our base case. What I'm saying, though, is that tactically you should be looking for slightly higher levels of yields to get, to add new money, if you like, the new money question, because the market has uniquely bought into this narrative that the Fed has put to us.
It's all relative to market pricing, of course, but if we were to reframe this and take a step back, and just frame it as follows. The biggest risk right now, the Fed being too tight too long or being too easy too soon. Are you suggesting it might be the latter and not the former?
Well, yes, I'm suggesting that they've gone a long way to reducing the former. The former is not the big risk now, right? They've told us, we're now priced to be at something we think is neutral by the end of the first quarter of next year. So that's not too tight for too long, I don't think. So they've, several months ago, Jonathan, we would have said, hey, that's a risk here. They're not getting out in front of this, but they've clearly sent the message they're going to get out in front of this.
Where would that leave the call on credit, Rob?
It's good for credit. A soft landing, a continued growth. We think inflation is not a problem. We think we're in disinflation. That's not to say that it couldn't crop up into the market's fears again, but we think we're in a disinflationary period. And disinflation, decent growth, easier policy, I can't think of a better environment for credit. I mean, overall, that is a great environment for credit. The fundamentals will be good, liquidity technicals will be good. The only problem is valuations. And there, you will still realize returns, but not as much as you would if there were very cheap valuations right now. So we are positive.
So it sounds like, Rob, all in all, you see this as an incredible positive, and maybe you get a sell-off a little bit on the 10-year to actually deploy more money to basically go into bonds. Is this basically a moment that you're telling investors, okay, just take that cash, wait a little bit longer, and put it all in?
Yeah, I think you characterized that right, which is the basic fundamentals are very positive. But let's not forget the market narrative has moved around a lot because we're all about trying to interpret where the Fed is going to go next. We don't have we've been very data dependent. We talked about that a lot. So the market is subject to variability here. And I'm just highlighting that the skew for that change in narratives probably would be for yields to be higher. But nonetheless, the medium-term view is very constructive on financial markets overall.
That's the story over the last week, that's for sure. Rob Waldner of Invesco. Rob, appreciate your inputs. Up another 5 basis points on a 10-year this morning to 380, about as good as it gets for credit, according to Rob Waldner of Invesco.
And a lot of people would agree, except for valuations. And if you take a look at that, you look at all-in yield, you can make an argument. But this is what a lot of people are saying. If the Fed gets their soft landing, a lot of things look good. And then you have to think, how do I come up with an original spin on this? Because ultimately, everyone's saying the same thing, and it's been right. So that's basically what we're going to be talking about for a while.
Up until you see a messy jobs report, up until you see that. Consistent theme on Wall Street.
Yeah, and that's, I think, what is really driving the uncertainty and the anxiety behind some people's comments. Although, Rob was just saying there is that maybe it's on the other side. Maybe we get a hot CPI print or something, and all of a sudden people worrying about inflation. But That feels difficult because nobody really seems to buy into this sort of massive rerun of inflation.
The difference between weakening and weak, layoffs. So we've seen a deceleration in jobs growth, but we haven't seen layoffs accelerate just yet, and we haven't seen jobless claims break out. Jobless claims last week were 219. The estimate for this Thursday, 225. The danger zone, according to Andrew Hoddenhorst of Citi, who thinks we are going into that deep downturn for the labour market, he thinks it's around 260. We're not close to those levels right now.
You don't normally see strikes. You don't normally see pay increases that start to inflect upward on the precipice of a massive job market deterioration. And I think that that's what some people are looking at. It's messy. You're also talking about the structural changes where you're investing in physical infrastructures. We were just hearing Jill Carey Hall talk about. So put those ideas together, and it's the reason why people are cautiously leaning into consensus.
How do you view the strikes over at Boeing? The prospect of strikes on the East Coast ports? Do you think that's the fumes of it?
It's unique with the Boeing story because the Boeing is in the crosshairs of so much scrutiny, so they're taking advantage of that, especially considering how many years they didn't get a raise, and that labor might be a part of the issue here. I don't know. I can't say this is sort of a wholesale view of leverage with the labor market because we used to see that, say, 6 months ago. It really isn't being seen quite as much.
I hate the I word, but idiosyncratic sort of applies on this front.
Yeah, it feels a little bit like that.
Equities right now on the S&P 500 just about unchanged as we count you down to the opening bell. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Staying on that issue, about 45,000 dock workers at every major port along the U.S. eastern and Gulf Coast are threatening to strike next month, just weeks ahead of the presidential election. A work stoppage could lead to supply chain disruptions not seen since the pandemic. One estimate says a week-long strike could cost the economy $7.5 billion. Talks have been at a stalemate since June. The AI-based writing assistant Grammarly has brought on a new CFO and CTO as it gears up for a potential IPO. Both new executives helped their previous companies get through the IPO process, according to Grammarly. Earlier this year, the company's CEO shook up the business to focus more tightly on AI. It's currently valued at $13 billion. And the votes are in for the best colleges in the country. U.S. News and World Report's annual rankings are out, and Princeton took the #1 spot for the second year in a row, followed by MIT and Harvard. Stanford, which tied for third last year, has fallen to fourth, while Williams College in Massachusetts reclaimed its spot for the best liberal arts college, and Spelman was voted the country's top historically black school. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, we'll set you up for the day and the week ahead and get you some detail on what's on the breakfast menu at the Plaza Hotel. Stay tuned for that. This is Bloomberg.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
The open about 38 minutes away. Equity futures up by 0.1% on the S&P 500 following a massive rally over in China, the biggest one-day gain since 2020 off the back of a big stimulus package. No big follow-through to U.S. equities. U.S. equities yesterday closing at a fresh all-time high, the 40th record high close on the S&P 500 so far in 2024. In the bond market, yields higher by 5 basis points, Lisa, a continuation of the trend of the last week, just short of 380.
Sort of sniffing out whether people have written off the risk of stickier inflation. Betsy Duke talking about how maybe there is a feeling that neutral is a bit lower than what it might actually be.
That's some of the price action for you. The day ahead, the calendar looks like this. More Fed speak from Michelle Bowman later on this morning. Later today, we'll get consumer confidence at 10 a.m. Eastern Time. Plus, the UN General Assembly beginning today. Tomorrow, Micron earnings out after the closing bell. Thursday, we'll get another round of jobless claims and more results from Costco. And on Friday, PCE and new mixed consumer sentiment. Over at the Plaza Hotel in the Champagne Bar, it's open for breakfast, light fare and cocktail services from 6:30 a.m. Eastern Time. And joining us now for breakfast is Tom Keene and David Gura. TK, what's on the menu?
We're having croissants today. John, I look at this, and the China's the same as the breakfast you and I had at Claridge's years ago. That was wonderful. What we're doing here is the Earthshot Prize. David, why don't you explain why I finished the beast?
Yeah, finish that croissant, which is, I think, dusted with pistachio, it looks like.
It is dusted.
We're having a number of finalists for this Earthshot Prize speaking today. We're drawing from that pool of individuals to come and speak with us this morning. Talked with Henry Fernandez of MSCI this morning, kind of dovetailing a lot of the conversation about sustainable investment, climate, with what we're seeing out of China this morning, and some vital, good conversations here.
The best conversation that I had, John, really the best conversation, and I think of Coventry, where you were real, and all the steel manufacturing and auto manufacturing there, is cleaning up the big factories of the world. We spoke to someone from France leading that charge. John Farrow, they have a long way to go.
Well, that was Faustine De La Salle, and yeah, it was a fascinating conversation.
Looking forward to the coverage. We'll leave it there, gents. Thank you. Tom Keene, David Gura on the latest at the Plaza Hotel. Not just eating breakfast and sipping cocktails, but covering some serious stuff a little bit later.
Sipping cocktails? It's 8:54 a.m. Eastern.
You
I don't
think that
so.
matters to Tom?
Well, I
Ramo,
think that
where have you been the last 10 years?
It doesn't go with pistachio-crusted croissant. I will say this is an interesting moment where suddenly every 4 years we end up with some real discussion, but it comes at a really politically fraught moment on many levels. And I think that that's really the reason why it is of particular interest.
Well, when it comes to climate, a foreign diplomat quipped to me yesterday, the United States every 4 years goes from zero to hero, which is why how much can on the sidelines of the General Assembly actually discuss the future of climate, especially the U.S. part of that, until we know the outcome of November 5th.
That feels like a lifetime away, doesn't it? November 5th, and then the Federal Reserve decision just 2 days later. It feels like we're stuck in this gap in between, waiting for a payrolls report and for earnings season to start.
And it feels like everyone is just searching for something new to say as they wait for something new to kind of come out. It's a very difficult understanding of how to kind of be counter-consensus when everybody's operating in the same black box, and that sort of seems like the case. I actually thought Lord Brown was very interesting when he was discussing some of the new innovations of where he's investing for 25% IRR. It's sort of an interesting way people are trying to play it in the details rather than the macro.
Quite a week in this market, hey? Lots of stimulus from China, Federal Reserve rate cuts last week, and talk of more of the same still to come in the meetings to come.
It's only Tuesday. We've got more. I mean, we've got bond auctions. We have consumer sentiment. Michigan, you miss.
Love those bond auctions, don't you? All right, coming up tomorrow, Dean Kernot of Macro Risk Advisors, Laura Rame of FS Investments, Sarah Hunt of Alpine Saxton Woods, and Victoria Fernandez of Crossmark. You joining TK and David for breakfast?
I am. Yeah.
Over there.
Yeah, I'm going to head over there. They have a pistachio-dusted croissant for me.
And drinks, apparently. As well.
Obviously.
Many drinks.
Mimosa.
From New York City, this was Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test.